Hey there, everyone. Welcome to another Ainslie's Gold Silver Standard Insights, where we break down the morning's news posted on ainslieBullion.com.au. I am Joe, and as always, we have the wonderful Chris Tipper, and joining Chris today is Josh Lang. Gentlemen, how are we?
Hey, Joe.
Good, thanks, Joe.
Excellent. What I will do, as always, I'll share the screen right now. Just want to briefly mention before we show the news, the Discord channel. Now, if you like these videos and you want to continue the conversation, head over to this Discord channel, discord.gg/gold. One or more of us will be there hanging about after you see this video uploaded, and maybe we continue the conversation, ask your questions, etc. But today's topic, the morning's news, on ainslieBullion.com.au was shocking eco data versus sticky inflation, market gyrates ahead of Jackson Hole. What does that all mean, Chris?
Yeah, thanks, Joe. It's a bit of a mouthful, but for the last couple of weeks, we've been debating whether rates keep going higher or whether a pause and pivot is coming. It really feels like a day of reckoning is rapidly approaching, and we may now be able to narrow that down to a very specific time and place. Friday night, our time, is when the US Federal Reserve Chairman, Jay Powell, will make his annual speech at the Jackson Hole Economic Symposium. His message will be critical, as it will likely lay out the direction the Fed plans to take regarding future rate hikes. The speech may ultimately lead to some level of market chaos, as currently different markets are guessing completely differently in terms of what the Fed is likely to do. The futures, bond and currency markets see it one way, and the equity market has chosen to interpret entirely the opposite. The markets are skittish because they don't like this level of misalignment. Clearly, both extreme views can't be both correct. So the debate, as we've been highlighting here on Insights, really comes down to a core question over whether the Fed will continue to raise rates for some time, and when rates stop rising, will they be held steady until there's clear evidence that inflation is heading back to the Fed's 2% target rate. I personally have been arguing that the damage has already been done, so the Fed will have no choice but to pivot quite soon, and the PMI data, which we'll get to shortly, shows this. The stock market agrees with me, but like I said, some of those other markets don't. And traditionally, those other markets have generally been the ones that have been more correct. So I might be on the wrong side of this one. We'll see how I go. When we have this much uncertainty and completely divergent views being expressed by the market, something is going to break and cause a significant capitulation that will determine which side is ultimately correct. There is a chance, depending on what he actually says on Friday night, this important central bank meeting will be the catalyst for that sort of breakage. What Powell says will really matter, and it effectively comes down to three things. For the market across the board to believe him that the Fed will actually do whatever it takes and not pivot as the economy hurdles towards recession, it needs to believe that, firstly, a slower pace of rate hikes doesn't mean fewer rate hikes. Secondly, that the slowing growth and a recession will not lead to rate cuts. And finally, if inflation fails to come down, that the Fed will, in fact, continue to push rates even higher. Like, Powell really cannot leave the speech open to any level of interpretation if the Fed wants to achieve its goals of bringing down inflation rates. So the Fed will understand this and want to make those 3 points absolutely crystal clear. But it will also be looking at data like the PMI numbers from yesterday and see that we're already in significant danger of a recession if we aren't already in one. And I've been arguing effectively that we're probably already in one anyway. It will be catastrophic if the Fed follows through on what it needs to do to kill inflation quickly and continues tightening into a recession. That's ultimately why I remain on the side of the stock market, that it's sniffing out a faster than expected pause and then pivot. Josh, I sort of want to hand over to you and see, what did that PMI data actually say? Does it align with my assessment, do you think?
Yeah, the data which we shared in today's news it's really interesting, Chris. Both in those PMI and the housing market data that we saw as well. I suppose, to put it in a short way, overall economic activity is actually slowing in response to the stiff run of interest rates that we've seen. The most stiff run we've seen since the 80s. So to begin with, those PMI figures you were speaking about. Just a little background for everyone on what a PMI is. It's a number between 1 and 100. Above 50 would represent an expansion, so growth, compared to the previous month. And a PMI reading under 50 is a contraction, so not growing, which is what it's doing right now. So To directly quote the report that was put out, they say the headline flash US PMI Composite Output Index registered 45.0 in August, down from 47.7 in July, and indicated a second successive monthly decrease in total business activity. The reduction in output was broad-based, with manufacturers and service providers registering lower activity. Service sector firms recorded a steeper rate of decline as activity fell sharply, while goods producers saw a modest drop in output. They also said in that report that material shortages, delivery delays, hikes in interest rates, and strong inflationary pressures all served to dampen customer demand, which seems obvious for us. August data also signaled a renewed contraction in overall sales as manufacturers and service providers struggle with subdued demand. And though modest, the drop in new orders was the sharpest in over 2 years. New sales are weighed down by weak domestic and foreign client demand as new export orders fell further and at a solid pace. So to put that quote, that great big quote in layman's terms, is pretty much saying that Fed handbrake that they've been putting on, which is how we referred to it in today's news, is quickly catching up, and demand is drying up on a global scale. So I also wanted to highlight, I thought it was interesting at the end there where they said the export orders fell at a solid pace, which is something we've been talking about, and it's that US dollar wrecking ball, something that's definitely a factor at the moment. And as if the vice wasn't already tight enough on the Fed, we had those housing figures come out as well, which further highlighted the recessionary pressures in the market currently. So the sales of new US single-family homes plunged to a 6.5-year low in July, as persistently higher rates, eroded the affordability. The report also from the Commerce Department yesterday added to the growing list of weak house data, and suggested that Federal Reserve aggressive monetary policy of tightening to slow the economy down to tame the inflation figures we have at the moment has actually achieved some results in the housing market. Saw housing sales, unfortunately, however, tumble 12.6% to a seasonally adjusted annual rate of just 511,000 homes last month, which is the lowest since January 2016. June sales pace was revised down to 585,000 units from the previous 590, so down as well. So we've had mortgage rates, which moved in tandem with those treasury yields. They've soared, with 30-year fixed rate mortgage averaging about 5.13% at the moment, up from 3.22 at the start of the year. So really, while the housing market isn't seeing the same roaring return as 12 months ago, it feels like a completely different world from 12 months ago with housing. The pain is still being felt by most people in the country whose annual interest rate payments are up about 2% already. So just to give people some context of what that even means, in the US, the average mortgage size is about $215,000. So people are spending about an extra $229 per month just in interest payments, interest. So things here, but at home in Australia are much more scary because our household debt to income ratio is much higher, sitting at 5.5. So in the States, they've got it bad enough. Here in Australia, even worse. Which I suppose wraps up and brings me back around to what you were saying, Chris. Friday night's going to be key, A, for the economy, and B, just for regular people, everyone who has a mortgage and how they can plan for the future with their finances.
Yeah, absolutely. And thanks for breaking all that down, Josh. There's a lot there. Those PMI numbers, falling home sales, debt servicing issues, and obviously you talk about the wrecking ball. We love to talk about the wrecking ball, the US dollar wrecking ball. They don't paint a picture for me that the economy can handle further rate rises when the signs of recession are already so clearly there. So unfortunately, for the Fed to get financial conditions to tighten, the share market, the crypto market, and as you highlighted, Josh, let's face it, hundreds of millions of people around the world suffer. So as financial conditions tighten, equity prices and valuations need to fall. It's an unbreakable relationship. That's simply how it works. You ease financial conditions, it's going to push the equity prices higher. You tighten those conditions and the price is lower. That's how simple it is. The futures, bond and currency markets are telling the world that there is no dovish pivot. And, potentially there never was. Because remember, those markets have pretty much maintained that line for a while now with only small variations around that. But the share market appears to have not gotten that message. And if Powell can deliver an undeniable message on Friday that, really, we need to expect a bit of a bloodbath, I think, because all the markets will then fall in line and believe the story that the Fed's telling. I'm still undecided personally. The real people I speak to are already very much aware of and feeling the impacts of high inflation and a slowing economy. No one's getting those wage rises because to cope with the inflation, you need the wage rise, but the businesses are worried about the recession risks. So I'm not sure how much more people can really take of that. And the most vulnerable people are the most in debt. So political pressure is going to continue to aggressively sort of mount as rate rises continue. Mortgage repayments and rent. I mean, I don't know about you, but that's the topic of almost every conversation I seem to have with anyone at the moment. Yep. So it's pretty rough. It's an unsolvable problem, really, without some sort of pain, whether that's today or in the future. So really all I can say is we've got to protect ourselves as best we can. And really it's going to come down to paying attention on Friday, because I think we're going to get an indication and probably some movement one way or the other.
Definitely.
Absolutely true. Friday is the big day. Okay, well, if we have any questions, either based on today's discussion that you're watching right now, or if you have questions based on tomorrow's morning's news as well, I always like to plug it at the very end. Of course, you need to send an email to insights@goldsilverstandard.com. That's insights@goldsilverstandard.com, or head over to the Discord channel. Again, one or more of us will be there to continue the discussion after we upload this video this afternoon. And also, if you have a question, again, you can either post it right into the main chat, as you can see here, or even you can DM one of us as well, one of the admins. So that's pretty much it, gentlemen. Unless there's any final thoughts, I will do the old wrap up, as we like to say here at Gold Silver Standard Insights and Ainslie Bullion. You have to balance your wealth in an unbalanced world, and that is very, very true, particularly for...
Well, that's the message coming into Friday anyway. Let's see what happens.
Let's see what happens, and fingers crossed for a good result for all. So without further ado, that is it from all of us at GSS Insights. Take care, and we will see you next time.